Hello and welcome everyone. We have a very special guest with us here today, all the way from Montreal. Chances are, if you've enjoyed the writings of Warren Buffett, if you've heard Chuck Akre speak here, you're very likely going to enjoy the message that François Rochon has to share with us today. He's one of the investors whose letters I highly admire. I love reading all of your communications. I love the clarity in your thoughts. And the special thing for us as Googlers is, this is one of the most successful value investors in the world today who started off as an engineer. So without giving away too much, I'd like to welcome François Rochon.
So thank you very much for inviting me. I'm really honored to be here. And I wanted to go do a presentation, and I call it the art of investing. So yes, I was trained as an engineer. I also had a very big passion for art. So when I started Giverny Capital, probably you've guessed that Giverny is the name of the city where Claude Monet lived. And so you see a little painting of Claude Monet on the first slide. So the art of investing, I call it the art of going beyond the numbers. So I got the idea really by reading Peter Lynch's book, One Up on Wall Street, and he said that investing in stocks is an art, more than science, and people that were trained to think very rigidly, to quantify everything. It's a big disadvantage when you invest in the stock market. So we're going to start with that. And so as an engineer, I was trained with a scientific education, so we're trained to develop a rational mind, to understand numbers, and I think it's a big advantage because there's a lot of financial beliefs that people that are trained in the finance business, I think they learn things that I believe are not really scientific, and we don't need to unlearn those things. But at the same time, scientific education, I think, has some disadvantages when it comes to the stock market. We're trained to look at past numbers on the belief that the future will be similar. Humans sometimes, they don't behave like atoms. So you have to understand that the financial world is a very strange world. And when you train to think very rigidly, it's hard sometimes to understand what's happening. And as a scientific, we're trained not to judge, but to gather facts. And judgment is a big part of the stock investing process. And also, we're trained to be very precise and right. But investing is about being imprecise, and also accepting that you'll be wrong 30, 35, 40% of the time. And that's a good ratio. So I wanted just to put a quote by one of the great engineers of all time, Nikola Tesla, and said that instinct is something that is important in science. It transcends knowledge. And I think that's a very interesting quote. But at the same time, there's a big difference between art, science, and alchemy. And during many centuries, alchemists tried to change lead in gold. And that's not really science. And so this idea that I have a great feeling about that stuff, that's not really art, neither it is investing. It's really just being lazy. So if you want to be an artist in the investing world, well, you want to master that art. So you want to first choose an art that you really love. You want to study the masters of that art. And also it's important that as master paints, investor invests. So you want to be active in your art, and you want also to develop your own style, have an independent mind, and always strive for improvements. And I have this quote by Woody Allen, and he said that in order to be a jazz musician, you have to listen to jazz. And it's an act of love. You listen to music, not because you want to learn it, but because you enjoy it. And gradually, through kind of a system of osmosis, it learns into you. And that's, I think, any art that you want to learn, you have to go through it, through an act of love. And I have this quote by Jim Collins. He said that you can either follow a paint-by-number kit approach to life, or you can decide to want to create your own masterpiece. And in the investing world, if you want to be original, you have to accept that probably you'll be different from the others, and you'll probably have to be eccentric, rash, unconventional. And that's a quote by John Maynard Keynes. He wrote a book called The State of Long-Term Expectation in 1936. And it is the long-term investor that in practice will be very different from the others and probably criticized at some point, because it's in the essence of his behavior that he'll be eccentric, rash, and unconventional in the eyes of the average opinion. That means that if you want to obtain better results in the stock market, you have to be able to stand in your own, and you'll be different than the typical crowd of investors. And that's sometimes hard to, it's fun when you look at that picture, but it's sometimes a little hard because you have to be different and have sometimes a very contrarian opinion than the average view on either a stock or the stock market in general. So let's look at the results of money managers in general in our investing world. So that's the normal bell curve of the typical results as investors. And this line here is the S&P 500. And the S&P 500 is not right in the middle for this very simple reason that managers charge fees. So they, from scratch, they'll start from the probably 1 or 2% behind the S&P 500. So just because of that, the S&P 500 probably beats out 85% of investors. So you want always to think what not to do if you want to beat the index. So if you want to beat the normal distribution, what do you want not to do? Well, if you think the same ways as most investors and you have the same time horizon, you'll probably end up with the same results. So also, if you own lots of companies, it's very hard to differ from the index. And I would add to that, if you believe that you're smarter than the others and you can predict the stock market, I think it's a road to failure. So what do you want to do if you want to beat the normal curve? Well, so far, in the last 24 years, we've probably been in the top 1% of investors. So let's hope it's not pure luck, and that we do have an investment approach that helps us to beat the index. So what do? We try to think for ourselves. We try to own very few selected companies and develop the right behaviors, which I'll go through a little later, but these are rationality, humility, and patience. So perhaps we can go through our stock selection process. So that's the science part of it. So we start with this financial strength of the companies. We want companies that have higher return on capital, that have grown their earnings per share, that also at the same time have a strong balance sheet, so the debt to profit ratio. Usually we want something like less than 4 times. And we want a business model that is very solid. So we want companies that are market leaders, that have competitive advantage and low cyclicality. And the competitive advantage is very important, and I'll go back to that point a little later. The management team, so we want the CEO, the CFO, the high management team to own lots of shares in the company. So you want a high level of ownership. So they're really in the same boat as we are. We want managers that have good capital allocation skills. They make constructive acquisitions, and they really think long term when they make investments. And then we add market valuation. So we want a stock that will purchase at a level that we can double our money over 5 years, which is something like 15% annual return. So without being very precise, because we know that probably it's an illusion when you try to be too precise, we try to have a view of what we think the company can earn in 5 years. And it's going to help us to modelize what kind of valuation we can expect during that time. A few words about art. First, I want to say that art and beauty are in some ways interrelated. And very few money managers talk about beauty, but I think it's important. How do you define beauty in the investment world? Well, we say that beauty, usually to our eyes, is something that is rare. we usually find something beautiful when it's something that we seldom see. So, and something that is unique is we never see. So it's really the rarest of all the beauties. And I always, sometimes when I read an annual report and look at the numbers, when I have this feelings, well, this is a beautiful company. It earns high return on capital. It has much better margin than their competitors. You know, there's something that lights up in my mind. So what you want is to find what I call masterpieces. And they have one quality. They're rare and unique. So I've taken some example in the art world. So the Mona Lisa, a Rothko painting, a Vincent van Gogh painting. And if you want to take some example of business masterpieces, well, I've gone through the history of the capitalist world, mostly in the US. And you know, we can start with probably one of the first technology company in the 1880s called National Cash Register. That's probably heard of Hewlett Packard that many years ago was a very innovative company. Apple, IKEA, TG Maxx, Geico, the insurance company owned by Berkshire, Washington Post, H.R. Block, Dun & Bradstreet, Gillette, McDonald's, Starbucks. I think all these companies, and we could certainly add Google to that lot, these are business masterpieces. So you want to study those kind of businesses and see what do they have that was so unique. And usually the uniqueness in either the product or the service or the culture is equivalent of having a moat that protects your castle, your economic castle, from invaders, which, you know, are competitors. So that's the key thing. You want to own a moat with lots of crocodiles and piranhas in it. So, you know, competitors don't want to come near your castle. So if we could resume kind of what we look for in a company, it's really three things. And the competitive advantages, which we could say is the artistic part of that, the financial strength, which is really the science part, and the management team. And this is where judgment comes into play. It's very important to be able to judge management. And, you know, that's kind of a subjective thing when you talk about judgment. But, you know, I always say, I have this phrase that when you meet the management, you ask yourself, would I like this man to marry my daughter? And if their answer is yes, it's probably a good man to be partnered with. So we end up with something like 125 stocks that fit our criteria, and the ones that we do buy for the portfolio are the ones that fit our criteria in terms of market valuation, that we can buy at a price today that we hope we can earn something like 15% going forward yearly. So perhaps just take a few examples to illustrate our approach. Well, one company I think is very unique is Walt Disney. They have great brand name. They own the Star Wars franchise. They own, of course, all those historical stars like Mickey Mouse and Winnie the Pooh, and they bought Marvel a few years back. And, you know, I always say that Mickey Mouse has three great qualities. First, he's highly popular and known all around the world. Second, he's immortal. And the third, he has no agent. So you really own your star. And that's a great thing for Disney. And the uniqueness of business model of Disney is that they have these big movie blockbusters, and like Alice in Wonderland in 1951, and then 50 years later they can redo a new version and make money again with the same name. And they did that recently with the Jungle Book. They released their first animated version in 1967, and they did a real live version last year, which was also a big success. So it's kind of like owning an oil field where you take all the oil, and 50 years later you go back to the field and there's even more new oil to take out, and you don't need to spend money on capital and, you know, pay people to guard your field. It's really an extraordinary business model. We bought that stock probably 11, 12 years ago. I think in 2005, we paid about $24, and it was the day that Bob Iger was named CEO. And we've done it since then. So there was a period when the stock did not do much. As you can see, for 4 years, the stock didn't do very well, but earnings kept growing, and we were patient. And if you look over the 12 years we've owned the stock, Earnings have grown about 13% annually, and in the end, the stock has more than quadrupled. So if you're patient and companies grew their value, eventually the stock will follow. I want to take another example of a stock that's been a while in the portfolio, CarMax. It's been 10 years in the portfolio. And as you can see, earnings per share have grown at about 16% annually since we bought it in 2007. And the stock has done very similar, even though the P ratio is a little lower today than when we first bought it. We first bought it in the summer of 2007. At that time, the P ratio was about 24 times. We bought more shares in 2011 at 14 times, and more shares in 2016 again at 14 times, and today the stock is about 18 times earnings. So even though the P ratio has been reduced a bit over the years, the stock has done pretty well. It's done about 13% annually, even though earnings grew about 16% annually, and that's about 5% better than the S&P 500. Dividend included has done about 8% annually over the last decade. So it's been a good investment. I want to say a few words about a competitive advantage. As investors at Giverny, what kind of competitive advantage can we have? Well, first, I think it's three things: patience, humility, and rationality. Humility. I think we do believe that it's impossible to predict macroeconomic events, so we don't try to predict them. Also, one key element is to focus on your circle of competence and to know where the limits of that circle is. And thirdly, we want to recognize our mistakes when we do them and always strive to improve our stock selection process. A few words on the timing of purchases. Woody Allen said that 80% of success is showing up, and so that's one of the main reasons we always want to be invested in the stock market, because we believe that owning great companies, not trying to predict the stock market, is the key thing to be able to beat the index over the long run. And by always striving for improvement, we try to study our mistakes in details. So each year on an annual letter, we have this yearly medals that we give to our best mistakes. And it's a very popular part of our annual letter. I don't know why, but because it's very painful. But I think that's very important if you want to continue to improve yourself. A few words on rationality. We try not to be affected when others make more money than us in stocks, because there's always fads, and we don't get into fads. So sometimes we'll be, different from what's going on in the very popular part of the stock market. But we try to be rational and say, well, if we don't really understand it, if we don't think that's a good area where our capital should be invested, we just stay away from it. And we try to be impervious to the stock market quotation in the short run. So it takes a lot of rationality, because the stock market can be very, very volatile. So we try to always be calm and try to always have the eye on the long-term horizons of the company we purchase. And we accept that we don't know the future, and we try to focus on, part of the process that we can control. It's really to, like I said, to look for companies that we understand, that we believe that have a competitive advantage. And, we accept that we don't know exactly how things will work out, but if you own great companies with great managers, eventually you should be okay. And that comes up to something we put out a few years back. I call it the rule of three. It's really to accept that 1 year out of 3, the stock market will decline by 10% or more. One stock purchase out of 3 will not perform as expected. And 1 year out of 3, you'll underperform the index. And that's the best managers usually underperform 1 year out of 3. So it's still a very ambitious rule, a group of rules. But if you accept that from the start, when you'll have some bad years and some bad investments, you'll be better prepared psychologically to deal with them. And a few words on patience. Well, I have this saying that patience is not the ability to wait, but the ability to keep a good attitude while waiting. So what's the good attitude in the investment world? It's really to focus on what's happening in the company, not what's happening to the stock. And that's sometimes a hard thing to do. But if you go back to the example of CarMax stock over the last decade has been quite volatile. It went down 25% a few times. But if you look at the earnings over those 10 years, it's been a pretty stable business. So if you just focus on what's happened to CarMax over the last 10 years, I think beside 2009, earnings went up every year, and it grew earnings by more than 16% annually. So just focus on that and forget about the stock price movements. You'll be okay. But I want to say another word about patience. That's not the same thing as being stubborn. And sometimes we fail to recognize mistakes we make. So I like to think about the analogy of how do you get a frog to be cooked? If you put it in boiling water, it will jump out of the bowl. So what you do, you put it on a mild water and slowly increase the temperature. And the frog won't get out because you always think, well, things are getting a little hotter, but they'll cool down eventually. So, and it never cools down and eventually get cooked. So what you want is not to buy a stock and earnings are a little disappointing, the fundamentals start to deteriorate, the stock go down, but you don't want to sell at a loss. So when investment doesn't work very well, I try to focus on what's happening to the company and to be sure that I'm not getting cooked like a frog. And that's really important. And there's a big difference in knowing when to keep your shares because the fundamentals warrants it, and recognize you made a mistake and just get out of that stock. And that's a big difference between being patient and stubborn. So to summarize, what differentiates an artistic investor? I would say the conventional investor, the typical investor in the stock market, either professional or amateur, it's really they focus on market quotes. They're short-term oriented. They have opinion on everything, and they try to predict when to buy stocks, and they cannot resist the latest fad. So I would say the unconventional investor, while he focuses on intrinsic value, he has a long-term horizon, he's agnostic about many things, including where the stock market will be in a few weeks or a few months. And at the same time, he doesn't try to predict when to buy, but he focuses more on what to buy. And I would say the right verb is what to own. And of course, he resists the fads and the popular beliefs. And it's easy to write in a presentation, but it's harder on the day-to-day to resist what's been very popular. So that takes a lot of independence of thought, I believe. So a wise investor must be able to kind of balance many things. So I talked about the love for the art, but at the same time, you want to be very rational. You don't want to fall in love with stocks. You want to always be rational. You want to have a very large fields of knowledge and look at many companies, but at the same time, you want to focus on your circle of competence. You want to be open-minded, but at the same time, you have to have independence of thoughts. You want to be able to value the business, but at the same time, like I said in this presentation, you want to be able to go beyond the numbers, so it's just not numbers. If it was just numbers, mathematicians would all be billionaires. So of course, it takes a little more than that. You have to have patience, but at the same time, you don't want to get cooked like a frog. And finally, you want discipline, but you want to be able to break the rules. So I always say that discipline is to follow your own rules, but wisdom is to know when to break your own rules. So sometimes we've bought some stock that didn't really fit our criteria, but we made a judgment call that we believe most of the time either the business has really something special or the management has really something special, or ideally both. So finally, to summarize in one sentence, to obtain better results than the others, I would quote John Templeton. He said that you have to do something different from the others. And at Giverny Capital, what do we do differently? Well, first, we think independently. We own very few selected companies. We have a very long-term horizon. I mean, I think on average, we own our stocks 7 years, and the typical investor on Wall Street is 7 months. So that's kind of a 12 to 1 ratio. And also we try to develop the right behaviors. We want to be rational, humble, and patient. So that's conclude the presentation.
Thank you. Thank you so much. Fantastic. So folks, I want to read something for you guys. I think you might find this interesting. So good businessmen or businesswomen are like artists. They have to do something with passion, something innovative and unique that will last and that will inspire others. In the final process, I try to figure out how much this marvelous company should be worth and try to buy it in the market at half of what I believe it should trade in 5 years if everything goes as planned, which is about 15% a year. So these two paragraphs are from an interview of Francois in the year 2005. And I'm sure it's kind of obvious how consistent your philosophy has been over the years. It's remarkable. It's sort of in the François Rochon of 2005 would have probably given the same talk in very similar words as I can tell. So what I want to ask you is, has it been easy for you to follow this approach consistently? Has it been tested over the years? Have there been times where you've questioned and sort of how you've thought about these things?
Yeah, it's been tested because, like I said, we have to accept that we underperform 1 year out of the 3. And, you know, in the good years, it's easy to say, but when those bad years happen, it's really painful. And, you know, when you have some partners, well, the word you use for clients, you have to explain to them why you have a bad year, and sometimes it can be tough, and it can last more than 1 year. It can be 2 or 3 years in a row. So that's, I think it takes a lot of conviction that you're on the right path and you're doing what you think is the best for, you know, your partners. And I think if the principles are sound, eventually they will work out. So again, the importance of patience, I think that's probably the most important quality you need when you invest in the stock market.
So to people who are listening to this talk, there might be young graduate students, people who are getting into the investing profession, or a lot of individual investors like ourselves who are saying, this is a good approach, maybe I want to try it. And, you know, they could have a couple of bad years to start off with. And what is your advice there?
I think there's the patience also, it's important, of course, but I think there's a quality behind patience and humility. You have to accept that you'll make some mistakes, and there's always things that you can learn. And I would say that the greatest quality of Warren Buffett is not necessarily intelligence, it's the humility. I mean, he's the greatest investor of all time, he's the greatest of all, but he's still very humble, always looking to improve and learn. And I think that's his greatest quality. He's 87 years old, and he's still striving for new learning every day. You always want to learn new things and understand new things. And if you have those qualities, I think I think you'll succeed in almost anything you do.
That's very interesting because, you know, he's been quoted to have said in interviews that if you have an IQ of 160, you might be better off giving 10 points to someone.
I think he said selling.
Selling, yeah.
Some points.
Yeah, selling. Sure. Thank you. Yeah.
Yeah.
So you do believe that, you know, it's more than the IQ, it's the behavioral traits after a point that are critical.
Yeah.
Okay. So any advice to individual investors, young investors who might not be professional investors like yourself? What are some best practices that one can adopt?
I think you have to look for companies that you can understand, because there's many companies out there. There's, you know, thousands and thousands, and, you know, it's hard to really understand all those companies, and some are just very complicated. So you're trying to play a hard game when you want to be able to value every company. You play an easier game when you're very selective and you just go for companies that you can understand. And it goes back to the analogy of Ted Williams, that he wanted to wait for the perfect pitch that was in the sweet spot zone. And I think that's the beautiful thing about the stock market. And Warren Buffett said that many, many years ago, that investing is the greatest business of all, because that's the one you can choose the ball you want to hit. So you have the luxury of standing at the plate and, you know, we're waiting for the perfect ball. There's no cold strike. And that's, I think, the most beautiful thing in the investment business. But at the same time, it's a very competitive investing world. So there's some disadvantage too, but if you have the right behavior, the right approach, and you're very patient and very selective, I think in the end you'll succeed.
Great. So in your presentation, Francois, you said you know, there's an element of beauty. Sometimes you recognize it, and you also said there is science and mathematics of investing. And I was wondering if we could take, you know, one company as an example. One of the logos on your slides was, I think, Starbucks.
Yeah.
And I'm sure like a lot of people here recognize the company. So can you describe what do you see in terms of, you know, the qualitative, the beauty-like aspects, and you know, like you said, what are the earning potentials 5 years from now?
Yeah. Well, Starbucks, I looked at it, I think the first time was in 1994. And I thought it was a unique business. And I remember coming to the US in the early 90s and, you know, drinking coffee in hotels. And it was, you know, bad coffee. And, you know, I said, well, if you go in Italy, in France, you have great coffee. But you come to the greatest country in the world and you drink bad coffee. I said, it didn't make sense. And when I first tried Starbucks, I said, well, these people are onto something. And they'll do well. And I remember, I mean, Howard Schultz was a very ambitious and very driven CEO, and he was very confident that Starbucks could have thousands and thousands and thousands of coffee stands everywhere in the US and in the world. And I thought it was indeed possible. And the only
Is the coffee better than Tim Hortons?
Oh yes, I think so. Yeah, but you know, I want to be patriotic here and say Tim Hortons is a great company also because it's Canadian. But you know, if I had to have coffee, I'll go with Starbucks. And you know, the only thing that prevented me to invest 23 years ago was the P ratio of Starbucks. And I remember it was trading at 40 times earnings, and you know, that was way too high for me. But I don't know. I didn't look lately because it's too painful, but the stock is probably 100-fold since then. So it's been a wonderful company, a wonderful stock, and never owned it.
So what PE ratio? You know, 40 is maybe too expensive, but what might be a PE ratio where it would merit your attention?
Well, with some insight, I would say that 40 times earnings in 94 was cheap because, you know, it didn't at all discounted the future growth to come. But you want a big margin of safety. And I think it was in 1949 that Ben Graham said that the cornerstone of intelligent investing is margin of safety. So if you pay a very high P ratio, you don't have as much safety as if you pay a lower P ratio. But is it 20? Is it 25? Is it 15? That's where judgment comes into play to help you decide.
Right. I think I'm trying to sort of make it more practical for people who are listening, just to you know, I think today it's like 23, 24 times PE ratio. And would that sort of a metric bring it, you know, you said you had 125, would it come up in those for you to look at, for example?
Well, I think the management is great. I think the business model is great. Just have to ask yourself where it is today, will they be able to continue to grow at a superior growth rate going forward, which I would define 12% or more. I mean, every company, even the greatest companies in the whole history, they come to a point where they hit maturity and it's harder to grow at a high growth rate. So, I mean, growing earnings at 8 or 9 or 10%, that's still quite an achievement, but it's not as, you know, exciting of growing at 15% or more a year. So it's going to be probably harder for Starbucks. But I've been saying that for a few years. I've been wrong so far.
So maybe let's just take a step back, Francois, for the audience here. What are some areas in the market where you do see, both the elements of beauty and that of value today?
Well, I think we took the example of CarMax, and I think that's a company that I believe can grow by about 15% annually for many, many years.
So revenues or earnings?
Well, probably earnings. Revenue is probably closer to 10%, but with some margin expansion and some buyback of shares, I think they can obtain a 15% growth in earnings per share, and it trades at 18 times earnings. So the P ratio is similar than the market, but I think the growth profile is probably twice as good.
Okay. I have a couple of questions. Just typically we ask all of our guests. What are some of your favorite managers or business people that you look at? And then the second part of the question is, what are some books, investing and non-investing, that you've enjoyed that you might want to share with us?
Well, managers, well, I have a deep respect for Mark Leonard at Constellation Software. Yeah. I think he's an artist. I mean, he's really unique, he's really original, and he has a very, very long-term horizon on everything he does. And I think Constellation Software, which, is a Canadian company, is, I think, I hope it continues to be, but if you looked at it today, it's really a masterpiece. It's really something quite unique, and a great culture and great artists at the helm.
It's interesting you bring it up because it's a technology company. Typically, value investors sort of, they've had this rough interaction with being in technology versus not being there. And also, it's one of those companies that has grown by acquisitions, which, again, value investors tend to shy away from. So how do you look at those two aspects?
Well, I would say there's many ways to get rich. So Starbucks is just having one concept and they clone it 1,000 times. And others company Berkshire Hathaway, that's an example of a company that grew by acquisition. It's an holding company that now have, we could say, hundreds of divisions. So there's many ways McDonald's for many years, that just a little bit like Starbucks, one concept that they cloned many times. So I think that in the end, what really counts is over, let's say, a decade, it's the growth in earnings per share. So if you have a great business model, if you have great management, if you have great return on capital, it will translate into earnings per share growth, which will translate into a stock that will go up. So if you pay a reasonable price and the earnings per share quadruple over a decade, there's a good chance the stock will do the same.
How do you apply the earnings per share concept to a company like, Berkshire you mentioned, but even Markel, for example, an insurance company where you may not realize the earnings because, they're just piling up on the balance sheet?
Yeah. Well, in terms of, for Berkshire or Markel, probably a price to book is a better, it's not perfect, but it's probably a better way to value. And you use a ratio, I think for both companies, 1.5 or 1.6 times book value would make sense, because that's the nature of their business. That's the earnings are more erratic, so you have to value in some other way. So you have to adapt to the business model of the business.
So Francois, we had one of our guests, they brought up a very interesting concept. They said, you look at all these great companies and you recognize that, there is a moat. And, over the past 10 or 15 years, they've displayed that in their numbers. And then you sit back and ask yourself, the future may not necessarily be identical to the past. So they said what really matters is, that the moat be growing. It doesn't matter whether it's small or big. So how do you think about growing moats or emergent moats versus established moats?
That's very hard, because moats always keep changing. And I remember a few years back, Charlie Munger said that I asked a question to Charlie about moats and all those great companies that seems to see their moat shrinking. And he said, well, I know all those moats are getting filled with sand. And so I asked him, which company do you think has an expanding moat? And that was 7 years ago. And he said, Google.
Interesting.
I think that's an incredible company. And I remember thinking, well, I knew about Google, of course, but I said, well, I should take a new look at it. And we bought shares in 2011 after that comment. So we were lucky because at that time the P ratio was 15 times.
Mm-hmm.
So if it would have been a few points higher, probably would have passed and missed an increase of 400% since then. So there's always new companies with moats. Some are expanding, some are shrinking. So we have to follow that closely. But if I had to choose one criteria to help me decide what's the direction of the moat, is the managers. I mean, those moats are not built by angels. They're built by human beings. So what makes a moat grow, I think, is something in the culture of the company. And those things doesn't come from thin air. It comes from the top management that builds that culture, and then it translates into a moat, and then high return on equity for the shareholders.
So when you look at the high returns of equity over the last 10 years, do you say it was because of the culture, or are there other things beyond just the numbers that you try and study to identify whether this is a culture you want to be associated with?
Well, there's many things. It's really what's the nature of the products, what's the nature, the funny thing with Google, it was not the first company that had a search engine on the internet.
Right.
It was the last one that come up with a new search engine, but this one was better than the others. I'm thinking Yahoo, Alta Vista, or Excite, all those Lycos, all those first companies that had search engine. So sometimes the first arrival, and sometimes strangely it's the last arrival. So that's the tough thing with investing. Every story is new and different. So you have to, when I said it's important to have an open mind, it's because if you have this very strict frame to analyze companies, probably you miss lots of things because every situation is new and the future is all oils, uncharted territories. So you have to have sound principles. You look for certain things, but in the end, you have to judge every situation differently and by their own parameters. And if you look at our portfolio, we own something like 25 companies, and I think the reason we invested in those 25 differ very much from one to the other. Sometimes it's really because of the management, sometimes it's really because we think the brand is very solid, and sometimes we think the company has lots of room to grow, and it's just like a Starbucks where they just have to clone the concept that they have built. So there's no one recipe. It's really to have an adaptive mind and trying to understand the nature of the business you want to invest into it.
So that leads into my next question actually, which is, when do you decide to sell? You said your average holding period is about 7 years, and you invest in quality companies, and you gave the example of CarMax, which you've been holding on for several years. But you sold a company like Intel, if I remember correctly.
Yeah.
So can you talk about how you think about selling companies, because you think of yourself as a partner, so it must be an emotional process as well, maybe. But
yeah, we try to remove emotion from the process, but it's never easy because we're a human being, so we're emotional, so we have to accept that. And sometimes accepting it and going beyond said, well, that's why we have those rules or process that helps them make a decision. And there's really 4 reasons we'll sell a stock. The first one, they realize we made a mistake, and that happened. And I don't know the ratio. It's probably 1 out of 3 or 4 stocks that we buy. For some reason, we've made a mistake. And the thing to do is just sell. Accept that it's part of the process and you're a human being. And it's a tough world outside. It's a tough world. And so when you made a mistake, you just sell and go into some other investment. The second reason, it's a little different, is that
he didn't really make a mistake, but the nature of the business has changed. There's a new competitor, there's a new economic environment, there's new technology, whatever has changed in the industry or the company itself. It's not as great as when you first purchase it. So when you realize that, you have to sell. And it can be a year after you bought it or 10 years after you bought it. The third one is probably when I look at the situation and I don't agree with the management decision. Usually it's a big acquisition. And when I feel that I don't agree with management, I just sell.
Okay.
I mean, I have this saying that if I had to resume in one sentence what investing is, it should become, you become partner with the top management. If you don't trust them anymore, there's no reason to be a partner, so we sell. And the fourth reason, which is probably the most common one, we just found an investment that we think has better prospects. And so we sell A to buy B, not necessarily because there's a problem with A, but just that we think that B will be more rewarding.
Okay, and finally, before we let it out to the audience, I want to talk about my favorite part of your annual letters, which is those medals. And correct me if my memory is failing me, but was Valiant one of the medals?
Yeah, it was a mistake. Yeah, we were lucky because we did make money with that investment, but it turned out to be a mistake.
Yeah, so can you talk to the audience, explain the medals a little bit more, and tell us how you give a medal even to something you call a mistake and still make money out of it?
Well, I always say there's a difference between being good and lucky. So we were lucky there. So that was still a mistake. Basically, well, we make many mistakes, and we only choose 3 to give medals to: bronze, silver, and gold. And most of the time, the mistakes are omissions. Stocks. Starbucks is an example. Is a company that fits all our criteria, and we decide not to buy for sometimes simplistic reason, and you miss a 10,000% gain over 25 years for that reason. So we try to give medals to the most costly mistakes, and the most costly are usually omissions. Sometimes it's like Valiant. It was a stock that we did purchase, and we made a mistake. Well, in the case of Valiant, I think we had a lot of confidence in the management, and also at the same time that much more debt than we're usually willing to live with. And we did a kind of an exception to our rules, and it turned out that it was a mistake. So,
But you got out way before, a lot of the other.
yeah, but the selection was a mistake. So it turned out, in the end, financially it was okay, but that's still a mistake. And that's the hard part. When you look at your mistakes, you want to be very objective and say, well, this is a mistake for those reasons. But some stocks that I didn't purchase that went up 100 times, but I really didn't understand. That's not really a mistake. It's just that you decided that this was outside your circle of competence and you missed it. But that's not really a mistake. It's a mistake when it was in your circle of competence and for some reason you didn't go through the purchase. Or it's a mistake when you thought that the company was in your circle of competence and in the end it was not. So that's basically the 2 reasons a mistake will be in the chapter of the annual letter.
It's interesting you separate luck and outcome, which is what one of our previous speakers, Michael Mauboussin, talks about, skill and luck. And then Howard Marks also says that, when he was here, he said, what will happen might be different from what should happen. So you need to decouple them in your thinking. But thank you very much with that. Let me open it up to the audience if we have any questions for you.
Okay.
Folks, any questions for Francois? Yeah.
Hi, Francois.
Hi.
Thank you for the excellent talk.
Thank you.
We've been reading your letters over the years, and it's really excellent. One of the questions I wanted to ask you was, you were showing us this chart about Walt Disney and buying it at 24 times earnings, right? How do you pay up for good businesses? Because the times when these businesses are available, with this margin of safety is maybe when something is wrong, maybe when the market rightly or wrongly thinks that something is off. And if that's not the case, then how do you pay up? Or if that's the case, how do you separate what the market is thinking versus reality?
We try to focus on the very long term. So we try to look 5 years in the future, and we come up, with our best judgment, what we believe the earnings per share should be in 5 years. So let's say Disney, when we bought in 2005, we said, well, we think this company can earn $3 a share in 5 years. And then, if you think that the fundamentals will still be good past those 5 years, we say, well, it probably will warrant a P ratio of, let's say, 20 times. So that gives you a $60 stocks in 5 years. So if you can buy the stock at $30 or less today, and you're right on the $60 in 5 years, you should be rewarded earning something like 15% annually. The earning that the company has today is not really relevant to that. So if they earn $1 this year, it looks a little pricey at 30 times, but if you have a long-term horizon and you're focusing on where the stock will be, or the earnings will be in 5 years, in the end, you'll be okay. So having this long-term horizon, I believe, helps you to defocus on the P ratio of today. And it goes the other way. If you find a cheap stock, but you look 5 years in the future and you don't see any growth prospects, there's no real reason to believe that the stock will be higher in 5 years. It can be higher in 3 months just because the P has gone from 10 to 12 times, but we don't try to invest for 3 months. We try to invest for at least 5 years.
Thank you.
Thank you very much for the great talk, and welcome to Google. So I have a question. Considering now the current market condition, there's a lot of warning by people about the risk, and there's a lot of fund managers returning fund to the investors. So I wonder, what do you think about the market in general, and what's the risk and the expected return for the maybe next 5-10 years? Thank you.
Yeah, well, of course it's not as exciting for an investor today as it was, let's say, in 2009 when stocks were really, really cheap. But it was scary then too. So I always try to kind of defocus what's happening to the market and more focus on the companies that we own in portfolio. And when we look at our portfolio, and we've got this group of 25 companies that we're pretty confident that they'll grow their earnings by at least 10 to 12% in the next 5 years, and the P ratio seems reasonable, there's no reason, I think, to be worried. I don't know what the market will do in the next 6 months, a year or two, but I think the companies we own in the next 5 years will do okay. And if you look at the general stock market, we don't have views in general, but we think that companies can continue to grow their earnings per share, let's say 5 to 7% annually in the next 5 years, and you add a dividend of 2%. So even though there's no P changes over the next 5 years, well, that would translate into a total return for stocks from 7 to 9%. So it's not as exciting as 8 years ago, but still it's pretty decent returns when you compare that to bonds, which probably yield something like less than 2% over the next 5 years. So it's not extraordinarily exciting to find opportunities, but I think the returns will be decent, mostly for the stocks we own, and probably the stock market as well.
We have one question over there. And
Thanks for the talk. I actually have a couple of questions. The first one is, I was just looking, I don't know if it's accurate or not, I was just looking at your holdings, and I noticed you have MasterCard, you have Visa. MasterCard, you have I think a position of 210,000, whereas Visa, you have a position of 35 million. I'm just wondering why you bother keeping MasterCard with such a low number rather than, because it won't even move the needle, right? Why not just put it all into Visa, because they seem to track each other anyways? So that's the first question.
Yeah.
And the
that's a very easy, we prefer Visa, obviously. And MasterCard, we own a few shares just to follow it. But we think both companies are great. These are fantastic businesses. We prefer Visa and MasterCard just to follow the company. We have a few shares.
Is it because of Visa Europe or?
No, just in general, I think Visa is an extraordinary business, and I think it's hard to say because MasterCard is a great business too, but I think Visa has a little something more.
Mhm.
And the second question was in terms of like the big tech stocks, right? I mean, I noticed you have Google, so thank you. But just curious.
Well, thank you.
No, I was wondering if you'd maybe give your thoughts on Apple, why you don't own it, because I mean personally I own a position in it because I think it's got a low valuation and it's got a very good moat around it, especially with all the services added to it. So just curious on your thoughts on that.
Yeah, well, obviously Apple could be in the section of mistakes because, I mean, it's up, what, 50 times in the last decade or something like that? So it's been a great investment. It's a great company. I mean, I can't argue with that. And the valuation does look very low. And I think they do have a moat. And probably 5 years ago, I wasn't that convinced that the moat was that large. And it turned out that it is a very solid business. And I think, I don't know exactly the number, but I think today 10% of the revenues are service-based and recurring, and as it gets a larger part of the revenues, I think the moat will be expanding. Still, a large part of their revenues and earnings come from selling new products. And when you ask to sell something new every 2 or 3 years, there's a risk that you'll miss a product launch or something will not exactly satisfy the customer for whatever reason, or you just have the risk also having another company that comes up with a new and improved product. So I think if you compare Apple and Google, I think Google business is more stable and more entrenched and more recurring, and I think the moat is larger in Google than Apple. That doesn't mean Apple is not a great business, and you have to ask yourself, at that price, the P ratio difference is so high. I think Apple trades at 15 times and Google is probably 25 times.
What about Visa?
Visa is close to 30,
So isn't that too high?
Well, I remember many years ago, Philip Fisher wrote in his book that common stocks and uncommon profits, the further in the future you can see growth, the higher the P ratio you can pay. So in terms of Visa, I think you can see the company having their moats protected for many, many years. It's hard to figure out who could hurt them. And you can see many, many years of growth. So I think that warrants high P ratio. But of course, it was better in 2010 when we bought it. I think we paid, I don't know, 15 times earnings. So obviously we had a much larger margin of safety then than we have today.
I've got one more.
I don't know if it answers your question.
No, it does.
Go ahead.
Maybe because I noticed like one of your largest holdings is Berkshire Hathaway as well, and they've taken a big position in Apple.
Yeah.
So indirectly, you actually probably own more shares of Apple through your holdings of Berkshire
there you
Hathaway
go.
than
So
Apple. I don't know if you look into that. That you know, I own this company and it already gives me exposure, so I won't own it separately. Do you look into that?
Well, that's not really a reason, but of course, when we own Berkshire, we own Apple and we own Coca-Cola and we own Geico and some Burlington Northern Santa Fe and Precision Castparts. So, and BNSF and Precision Castparts was in the portfolio a few years back, so we're still shareholders. So, but you know, if we thought that Apple was a good purchase for us today, owning Berkshire wouldn't be a reason not to do it.
So Francois, when you look at something like Visa or Apple, your portfolio has low debt companies. Sometimes they might even have excess cash. So when you look at the PE ratio, you take the cash out. How do you?
Yeah, you should do that. I think so because I mean that's cash that could be returned to investors. It's a little harder for Apple or Google because a lot of those cash is in other countries. Sometimes it's a little complicated to get back in the U.S. the cash and give it to shareholders. But in the end, in some ways or the other, this cash will be returned to shareholders, I hope, and it should be taken out of the valuation. But what you want to do is really do the sum of what you expect the cash to be generated by the company in the future, discount it to today, and then you add the cash that is today. So you get a proper valuation.
Great. Well, makes sense. With that, Francois, thank you so much for being with us here today.
Thank
Really
you.
enjoyed your presentation and your talk. And thank you all for being such a great audience. Thanks. So nice to have you.